one possibility is quote unquote increase cash revenues. Okay, and the way you do that is you increase the tax rate, or however you adjust the tax schedules. There's various ways to do it. The other way to do it is you tighten up the benefits so you can't start collecting the benefits until older. Life expectancy now is much longer than it was. All of these things have been discussed. But the real question is, why not adjust the made-up accounting formula? Since they're making it up anyway, why not just make it up so this number here goes to 2050? Because they could, and it's a real simple way. An economist wrote about this decades ago. I didn't have a clue what he was talking about until I got into it. They reward and do the accounting based on these faux treasury securities, which have faux interest rates on them tied to treasury rates at the time these faux securities are issued. Well, what's so special about treasury interest rates? Why not say, well, maybe they should make it treasury interest rates plus 100 basis points, or treasury interest rates plus 200 basis points, because those who have played around with the numbers know that, well, you know, if we just go back and change all the accounting and do the credits, this number here, this date, is very, very sensitive to the path of interest rates and the interest rates. During the Bush administration, George Bush, not George H.W. Bush, they had a whole thing because he was thinking of trying to privatize the Social Security system. And so there were lots of studies. Should they invest in stocks because that would increase their average rate of return? And Alan Greenspan said, the last thing we want is the US government to be owning stocks. But the real point, that's when I started to delve into the accounting and came to understand that this accounting structure is, it's not right to say it's make-believe, because it's not make-believe because Congress put it in the law. But it's as close to make-believe in the sense that it's not consistent with any kind of accounting firm's accounting of how you account for things in these kinds of systems. And it can be fixed in a lot of ways, and it's always useful to remember. On a cash basis, right now, the Social Security system is putting out more cash and benefits than cash it is receiving. Okay, nobody's yelling and screaming about that, and that position is going to grow over time because of the aging of the population. That difference is going to grow, but it's this accounting that says, well, if they don't do anything as of 2031, I think it's changed now to 2032, it's 70% of the benefits, is according to the annual report. Yes. Right, right, right. But that's cash. Yes, but that is cash, and that's included in the revenue system of Social Security. That's real stuff. Yes. Yeah. Yeah. Crimin publishes twice a week plus notes, and I read him religiously. He's got books based on his columns. He's an excellent economist. And the real question is, as you write from a standpoint of an op-ed, what do you want the readers to focus in on? He's never done this particular. I'm sure he'd agree with it because it's straight economics to do this. But the real point is, it isn't the Social Security system that is the real economic challenge. And from a standpoint of deficits, if you want to make changes to it, you can quote people have there are all kinds of numbers that have been run. You can tweak, you can increase the tax rate a little bit, you can defer benefits a little bit. There's all kinds of ways to adjust this in the real world to adjust the cash flow if that's what your overall goal is. Medicare is different. Social Security is transfer. It is taking money, cash, from people paying taxes and giving benefits to people receiving the benefits. That's called a transfer system. Medicare is both a transfer system because it's highly subsidized, but it is using real economic resources. There's no question about it. And with the aging population, it's going to need more economic resources. And if we do not figure out ways to control the rising costs of providing Medicare, you've got a multiplier effect in terms of its impact in terms of economic resources. You've got more resources being utilized, even if they control costs because of rising demand in the aging population. So part of Obamacare was referred to as making the curve in the cost curve. And what it says was there's an enormous amount of focus on deposit insurance, but the real problem is the provision of healthcare services. That's where the real costs are. And because they preserved private health insurance, Obamacare is as complicated as it could be, but that's the nature of a democratic system. It was hard enough to get through. It's had huge benefits, and they have done some things to reduce the rate of inflation, the rate of real costs over the inflation rate than what was happening previously. But it's still, because of the aging demographics, that's a big economic number. Oh,
so, and unlike Medicare, where they can set a fee, and that's all they pay.
Right.
They can't really do that when they're giving insurance companies that they negotiate with providers.
It's
so plugging into that system by definition limits what you can do.
Oh, keeping both of them is incredibly complicated, as those who have looked into Obamacare have looked at. It's incredibly complicated, but it is doing a lot of good from the standpoint of there is a much lower rate of lack of insurance than there used to be. Okay, so forecast states what economists care about is cash. Cash is king in the world of finance, and cash is king in the world of economics. Okay, cash revenues plus accounting versus cash benefits, and then when the fund balance goes zero, this is the statement that, oh, as everyone knows, the Social Security system is going bankrupt. Okay, that was part of what George Bush wanted to deal with. There seems to be every few years, they seem to want to go through it. They're going through it now because of the size of the deficit. And it's confusing to the public. As far as I know, when I've taught this diagram before, very few people know about this in terms of how the system really works. And that this accounting system is the creation of a commission in the 1980s in order to address rising deficits in the Social Security system. This is what they came up with, and they're going to have to make adjustments. As I said, economists care about date one because it's real economics. Dates 2 and 3, as I've said, are based on legal and political agreements. And don't tell me they can't change them. They can change them anytime they want.
People are screaming about Social Security going bankrupt.
Yeah, the word bankruptcy, that is a scare term.
Later on, I have the and I kept saying going bankrupt, is there gonna be anything there? So,
Yes, 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 yes. Will they, is my expectation that the politicians, as they get closer to these dates, is my expectations they'll come to some resolution, some mix, some compromise. Well, based on their behavior today, it's hard to believe they compromise on anything, but in general, there's a force out there, and the force is, of course, I believe everybody in this room of this age cohort votes, and uh, they like Social Security, and they like Medicare. Okay, so economics versus finance. One of the reasons I go through this is because it's about the difference between economics, finance, and then politically created financial rules that don't align with real finance. And what we know from those who've run, there's lots of people looking at this, run lots of numbers. The Social Security system, it doesn't take that much. Of what you care about is the cash balance. If that's what you care about, it just doesn't take that much. It's just that if you start talking about, for example, uh, 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 changing the retirement age, well, for office workers, changing the retirement age a couple of years probably doesn't mean anything. But if you're in the manufacturing sector working on automobiles or something like that, it could very well be. So it's very, very uh, it's very political, and it has distributional effects in terms of how this gets resolved. And this is the slide that says the Medicare system is entirely different. We should recognize its difference, and it comes down to this concept of basic economics. It's the difference between a transfer, which has distributional effects for sure, but in terms of real economic growth, it's almost a nothing. Okay, whereas Medicare is in fact consuming services, and they're going to be consuming more economic resources over the next 20 years as us baby boomers age. Okay, so this is just what I've said in terms of the mechanics about how it works in terms of quote unquote selling. One of the ways they address their accounting needs is they quote unquote sell, which implies that there's a real security to sell. There is no real security. It's a faux security. It's just numbers in a computer account in terms of how it works. And so when they sell the security back to the US Treasury, they get a credit in terms of adjusting their fund balance, but there's been no exchange of cash. It doesn't have anything. The cash for the Social Security system is the same. The cash coming out of that system is coming from taxes paid. Okay, and if there aren't enough from the Social Security taxes and these other taxes, well, the cash is paid out of the US Treasury. That's right. Okay, so I've got a couple of special topics before we go to the next one. Yes. Those Okay, so I'm repeating questions because it's important that people at home hear about what happens about the cash reserves. It's not cash. It's numbers in a computer system. There is no cash. The cash is the revenues and the benefits. That's it. Everything else is the accounting rules that they rule, because the cash at right now, okay, because as I've said, the revenues aren't enough to pay all the benefits. The cash is coming out of the US Treasury. It's part of the expenditures of the US government. And, whatever they do, anything that they do that has to do with the accounting is all about the accounting. Doesn't affect the cash at all, until, according to the law that they adopted, the accounting says, okay, you can't pay your full benefits. And they have in the annual report of the Social Security Administration, this table I think is a year out of date, they have a whole statement that says, under the law, If no adjustments are made, our expectation is that beginning 2032, we can only pay about 72% of the benefits. I can tell you that as they get closer to that, my expectation is the fear would generate a good deal of political comment. Yes. Okay, so you get into retirement systems. I mean, the U.S. was quite an innovator in the 1930s and design. They made lots of adjustments to the Social Security system since the 1930s. I really shouldn't comment on the government retirement systems in other countries because I haven't studied them, and there could be lots of variances on a thing. Lots of variances. Is that true? Yeah. Yeah. I don't think they're trying to teach you something that isn't true about New Zealand, as you'll see. So the rest of this lecture, not today, but this just a short couple of soft topics. One of my favorites is to talk about the defined benefit retirement plans. And the reason to talk about this is there's some real basic finance out there having to do with defined benefit retirement plans and a lot of preferences, and it has a big impact on local and state governments. You may have read stories about this in terms of how they go about doing this, but the finance is actually pretty straightforward. It's amazing in terms of complexity how they work. So the first thing to note is what household net worth is. There is a report by the Federal Reserve. They estimate household net worth every quarter. We could talk about how large it is and why it is so large, but a big hunk of net worth of households is sitting in retirement plans. And they're broken into two kinds: defined contribution versus a defined benefit. They're very important to the lifestyles of those in their retirement years. There's no question about it. And you can look at all pensions as a percentage of net worth. I mean, it's running about 30% of the net worth of households. Okay, so here's a question for everybody. If the GDP is 25 trillions, how is it the household net worth is almost $150 trillion in the United States, based on the Federal Reserve estimates of net worth? Does anybody know why? Fundamental finance. Okay, remember that story where I said, there's a difference between stocks and flows. And one of them is the difference between value and income. And it turns out GDP is a measure that is capturing the utilization of economic resources over the course of a period of time, whereas net worth is a measure at a point in time about future cash flows and discount rates and the present value of all of those things. And when you start doing those things, you start getting multiples potentially of someone's potential of income, depending on what their holdings are. And when you sum up across all the households, you get a much bigger number. Such things, for example, what is the value of your car today? What is the value of the furniture in your house? What is the value of your house? What is the value of your investment portfolio? What is the value of your pension fund? All of these things matter. The one thing that they don't include in there is what is the value of your future Social Security benefits. That is not included in that. And they look at what is called percent of the dollars held in this, and something happened in the United States, which is the percent of retirement dollars held in the defined benefit plans in the private sector declined. We've all witnessed this. Corporations used to have big defined benefit retirement plans, and they didn't all completely go away, but they all got reduced. And the reason they got reduced was because of accounting changes, which I'll explain in a minute. And the big holders of defined benefit plans are federal government and state and local government. No question about it. And defined benefit retirement plans, well, it's a specified cash flows for as long as you live and usually for as long as your spouse lives. That's typically how the defined benefit plans work. They have inflation clauses. They might include health adjustments in terms of being indexed. And as I said, it used to be the prevalent. You go back to the 50s, it was the prevalent type of retirement plan. And yes, in that system, you're a creditor to the company and your pension is at risk if they go bankrupt. The famous story that got ironed out in the Supreme Court had to do with United Airlines. United Airlines went bankrupt and the pilots who were in retirement lost their pensions, and going on to the government agency that did it, their pensions were significantly reduced. It's always useful to remember who actually owns and who manages these things. And it's happening now in local governments, where you're hearing stories about the pension system of any particular entity, City, County, San Francisco, Novato, Marin County, you name it. They're all struggling with, they have made promises in the labor contracts going back years, and those contracts are and paying those defined benefits going forward, there's not enough, they haven't made a huge enough return on their investments to be able, under the rules, to claim that they're fully funded, which is the term. So defined contribution plans, you own it. You own the risk, you know. If you put it in, you can put the money in all kinds of weird stuff and you can lose it. But one of the things is, and this is key from a standpoint of distributional effects, defined benefit plans cannot be passed on to your progeny in most circumstances. 401ks can. 401ks, and one of the concepts, those who've been studying this for years have noticed, the idea of the 401k is, of course, it will provide you income in your retirement years. The balance will decline over time as you age, and when you pass, there'll be very little left. But that's not what's happening. What's happening is elderly are managing their 401k systems, and they're leaving a lot to the next generation. So those who are wealthier are leaving bigger inheritances through their remaining 401k system, which is a force for concentrating wealth rather than mitigating wealth. There are tax benefits associated with contributions. There's tax rules regarding how you have to take money out in your years. They keep getting older and older. I keep getting notices from my financial advisor. Oh no, now you don't have to worry about this for another 5 years before you have to declare how you're going to take this stuff out. And a lot of people do not understand the subtlety of the tax consequences. The whole idea is it's deferred. It's a deferred tax. You pay no taxes on the gains and the income that's sitting inside these deferred retirement plans. Fair enough. Yeah, but suppose you bought Google stock and you bought it early and it's in your retirement plan and you've held on to it and it's worth zillions of dollars, and now you got to start taking it out. Well, if you just bought it in a non-retirement plan when you started selling the stock, it would be at a lower tax rate because it would be considered a capital gain. You put it inside the 401k system and start taking it out, it is income, and it can be, depending on how much is gained, it can be taxed at a very high tax rate. So what that story is about the complexity of the tax system. which I'm sure we all know it can be very complex, and you're making decisions earlier in life, not really realizing how these things might play out. Yes. Yeah.
But you can't treat that as capital gains.
There's no capital gains. Pulling it out is income, period. No matter what, no matter what. And I should say, oh, you always got to put the caveat. I am not a tax advisor. Could there be loopholes? Could there be loopholes on that? And the answer is sure. Okay, this is the reason I pulled this up is called FAS 87, 1985. So how does it work? Under the SEC, there is a whole structure called the Financial Accounting Standards Board, which is promulgating rules regarding how do you account for things, financial things. And trust me, there's a lot of stuff going on in accounting. It's really complicated. So one of the things they decided was the whole valuation of these pensions, these defined benefit pensions in these companies was not being done right. And they started to use, rather than the rules that we're using before, a fair valuation construct, which is how much, what is the value of what you're promising to pay over time? This is discounted cash flows based on expected, you know, you've got enough employees, you can get a pretty good estimate of what the expected cash flows will be over time. You discount them to the present, you say, that's the present value of what we've promised, and you've invested in assets. They're all marketable financial assets for the most part. You got that value, and if there's a difference, they say, oh, you got a shortage, you got to fix that. Well, what happened because of the accounting is private firms said, you mean we're going to have this flow through our income statements, this volatility associated with the stock market? No way. And that's when they really started to cut back. And the 401k system, it's not coincidental, came out roughly at the same time. And that's when they started setting up, oh, well, okay, we have a smaller defined benefit system and a much larger 401k system. We might match your contributions or some proportion of your contributions. That was the evolution to the 401k system and the decline of defined benefits in the private sector. That's why. Is this group? No one, trust me, I used to work for Deloitte. I know some of these guys in terms of how they work. And it's incredibly important. And when it breaks down, what do you have? Enron. That is a classic case of where accounting breaks down, yes.
Started to replace defined contribution. What was the effect? The amount of defined benefits way less.
That's this. Yes. Look at how it's really started to come down right around here. That's why. Yeah. They didn't, the managers, corporate managers, they don't like earnings volatility because it affects their stock price. It affects how much they get rewarded. Just like the rest of us humans, they want things to grow smoothly over time. All this volatility, it just generates a bunch of noise and things they have to worry about. And because of the change in the accounting rules, it increased their declared corporate earnings volatility. And the way they addressed it over time was to they still offer retirement plans. They're just more heavily weighted to the 401k defined contribution plans. The public sector, no, they didn't. Politics, because of preferences, people, remember these things about value versus cash flow keep coming up in various kinds of dress. One of them, remember when we talked about the value of a treasury bond and how the value of the treasury bond even though you know as certain as you're going to know what the cash flows can be expected over the life of that treasury bond. Its value's changing with the volatile yield curve all over the place. That's why I asked the question, well, it's yours. Do you care? If you don't care, it's a great way to manage. It's a great way to manage your investments. It's the same choice among retirees and why they have politics, because why? There's a whole bunch of people, particularly unions, that care about defined benefit retirement systems. And they know what they're doing. They're educated. They've lived with it. The structures of defined benefit retirement systems, very, very complicated from a standpoint of how you reward people. This is where you hear employees, your benefit is based on the last 3 years of your employment. So one of the things, for example, a lot of teachers like to do is they like to become principals for 3 years. Why? Because principals get paid a lot more than teachers. And what is the thing that happens? Well, they got a leverage effect on their defined benefit. They know what they're doing. Yeah. Well, the problem with that, of course, is the people making those decisions are city councils, local governments, water utility districts. Well, I have been told this anecdote. I have not yet documented. I was told the Novato City Council was told by CPER advisors, the stock market is so overvalued, you don't have to worry about rewarding compensation and higher pension benefits rather than wages. And that's something they care about because of revenues and being able to spend stuff. Well, they just promised the pension benefits later. And for any professional to say you never have to worry about the stock market, of course, is crazy talk. And exactly what happened, which is in 2008 and 2009, the market declined a huge amount, impacting the valuation of local government pension assets. And they can't fully invest in stocks. Why can't they invest in stocks? Well, because they need cash. They have to pay out to their beneficiaries. And oh, by the way, you'll see in the next lecture about interest rates, how interest rates were really low for 10 years. Well, that means they were earning very low on interest rates, which means the rate of return they were earning on those investments, and that position grew. And under the rules of various pensions, one of the things that happens is the pension plan says, stick them up. You're so out of balance, you have to make a contribution. That's cash. And that's where you hear cities and people yelling and screaming about the payoff to local governments that they're overpaid because of these defined benefit pensions. It's going to get more political. It's going to get more political in the coming days. And it is why I talk about it. Because take a look at what the Federal Reserve report says. First, the red line, based on their measure, federal pension benefits are underfunded, and it's just part of the deficit based on the accounting, and we don't care. Okay, I mean, is it a problem? The answer is not really, because it's the federal government and it also controls a central bank, so we'll ignore that. Private defined benefit plans. Look at the purple line there. They're not, they've wiggled around, a little underfunded, a little overfunded. State and local government, the underfunding is, hello, this is trillions. This is trillions of dollars across the United States. This isn't just California. This is across the United States in terms of the underfunding. And how do you make up for them? Well, local government agencies, they're negotiating with the unions, they're making adjustments, they're putting newer workers onto 401k systems now, they're making adjustments, they've got split pensions versus those who are already on the retirement system versus those who are working on it. It is extraordinarily complicated, and the politics is worse. But the reality is they're the ones that made the agreement. And so one of the things you hear, which is not true, is that state and local government workers are overpaid. And the answer is no. These are negotiated contracts based on how workers are compensated in terms of their overall structure of their payment. It's it's a gold mine for economists. Yes. You are. Yeah. Okay. So the question is, do negotiated salaries take account of the benefits? And you bet they do. Why? An awful lot of state and local government workers they're in professional jobs. You need trained individuals to work in these jobs, because if they don't, they can mess stuff up. They all live in a labor market, and those workers have alternatives. If you do not pay them a reasonable wage, you're going to be left, by definition, with all the worst workers. If you overpay, and so they constantly do measures of compensation and the value of retirement benefits, the medical benefits, and all these. Police and fire are notorious. How they adjust such things as overtime. This is one of the reasons why you find police and fire, for example, boy, do they like overtime. Why? Because it increases their income and it increases the calculation. People get upset about double dippers. Okay, and it's just one of the, if you go to work for a particular agency, okay, and then change jobs and go work to another agency, and they're on the same retirement system, you can't double dip. They won't let you, because if it's CalPERS, it's CalPERS. On the other hand, if you're in one retirement plan, say Marin County, and you shift to another agency that's on CalPERS, well, you can get the pensions for both. And people yell and scream about this, but the reality is this is happening in the private sector too, because people who go to work and work for one company that has a defined benefit retirement plan, they don't lose the benefits when they go and work for another one, so they can double dip too. It is part of the process, and one of the things that happens in that particular sector. So one of the things to note is, if you've ever gone to a city council meeting and they're talking about finance, just ask yourself, do the elected members of that board understand any finance? Some do, some don't, and they're making financial decisions that have a long leap. And I mean, I've talked to the mayor of Novato about this. Did this really happen? And I said, yeah, it really did happen. I said, did anybody in the council object when a CalPERS rep said, oh, you never have to worry about your pension system? Because now they're paying out a lot of money to balance their pension books. They're on the CalPERS system. This is what alerted me to this particular problem, and being glutton for punishment. I of course like the day I was shocked when it happened. And the argument is, as soon as they start paying cash to balance their pension books, that's cash coming out of other local government programs and services, police, fire, you name it. Well, whatever it is. If they're spending actual revenues to balance out because of the volatility of the stock market and interest rates, okay, so their choice is they're trying to negotiate with various worker reps and unions. It's a highly unionized sector for the lower wage workers in that area. So this is one of the consequences of poor management, and no one's in charge understanding fundamental finance, going, wait a minute, what are the odds that'll never come up? Well, what about, I mean, any good financial advisor would tell you, never is a big word, 50% chance. Well, it actually happened. And the other thing to note is you just have to realize pensions are really complicated, and their issues associated with 401k in terms of taxes, their distribution of wealth issues. I mean, how many people know that the 401k system has had the opposite of mitigating influence on the distribution of household wealth because of the way us humans behave, which is, oh, you know, when we pass, the progeny get the assuming you have progeny, et cetera, they get the 401k system. Okay. I'm going to skip modern monetary theory. And does anybody here want to hear about modern monetary theory? I'm going to skip through that. And Alexandro, I'm ready to switch. Switch to the next lecture.
Sure, I'm coming right in.
Yes, here's the highlight. It got a lot of cachet because this gal, what's her name? It was first pioneered in 1992, but one of them became an advisor to Bernie Sanders. And the essence was what they tried to sell the public is, oh, you don't have to worry about the deficit as long as you have your own control over your own currency. And well, that made just 1 second. And we made people, oh, great. We don't have to worry about the deficit. We can continue spending any way we want to spend. Why should we worry about it? So it got a lot of cachet. And the problem is, it's obviously it's not that simple. No, deficits matter. Okay. What I tried to convince you in this series of lectures having to do with federal debt, they matter a lot. They can be used for a lot of good, and they can be used inappropriately, and they can overstimulate the economy. And one of the consequences is if you overstimulate the economy at the wrong time, you can generate higher inflation, which is going to be the issue in our next lecture. So let's take a 7-minute break. We'll get up at 10 of, and then switch over to the next lecture. That was pretty fast. I understand that. We don't want to talk about it. Yes, that's her name, Stephanie Kelton. Yeah. Okay. Yep. We don't need to do that either. Okay. So no one's going to take a break. Yeah. Yeah. Now's the time.
Like now, if you pass your higher income onto your children, they have years to spend. They can't reinvest. So
They can't contribute to it. Yeah.
They actually have to. They can't keep it there forever.
Yes, but well, they do at a certain age. They have to specify a schedule, and they keep raising that, so I don't have to specify a schedule yet. Yeah, it's a tax liability, but it doesn't take it all.
Yeah.
It's not.
Yeah.
They're gonna need it. It's
Yeah.
gonna get used.
Yeah.
And so they're not building counter-generation at all.
Yeah.
Whereas somebody who can live comfortably and just.
Right.
Oh, yeah.
I know.
We should go to what, number one. Yeah. So did you have you have another question? Go ahead. Oh, I'm not a financial advisor. Yeah.
Paying the taxes.
Oh, yeah, that's you have to ask a financial advisor. Typically at our age, it doesn't pay to transfer. That's what I've been told, but I don't know the details. I'm working. There I am. Yeah, my son did that, but you know, he's much younger.
Test.
But anything like that, you got to know your position, and you got to have a financial advisor that knows your position and what your preferences are. Okay.
What we can do, I know it's kind of hard to remember to repeat the questions for the people on Zoom. You could give them a mic if you'd like. It becomes that.
Oh,
So if you want to, like the people who want to participate in class, you can hand them a mic, and that way you don't have to repeat the question.
okay.
If you want to try it that way, it's up to your call.
I haven't used it yet. I haven't used it yet, and giving me new electronics is always dangerous. You know what I mean? You know, holy cow. Okay, let's get started on the next lecture, which is going to be about the Federal Reserve. Yes. A question. Underfunded. Seriously underfunded. So is there anything that forces the state to not underfund CalPERS to such a great degree, or other states? Consider the dynamics of the political problem. So it's underfunded. I don't know the specific rules of CalPERS regarding how much CalPERS is underfunded, nor what the rules are regarding the payment of benefits. But you're paying benefits, okay? The underfunding calculation is about future benefits, right? Are you going to cut benefits to current retirees to help balance those books? Wow. That's not just a political deal. That's a human deal, because retirees, by then they've made they've got their expectations and all kinds of things going on. It's very, very complicated. There's a lot of people think the state's just going to bail out CalPERS and the underfunding. They're just going to, right now they're not, because of the state deficit, but eventually it's very political how you address that question, because you've got different factions, and you pretty much have at least a consensus view that it would be a really bad thing to take it out of the income of those who have already retired. That has real human problems to it. Well, what about people who are 55 and close to retirement? Would you suddenly tell them, oh, we promised you all these benefits for the last 25 years of your work schedule, but now we're not going to meet them, so we've cut your retirement benefits? It's just not that easy. It's complicated in terms of who pays. Pardon? Yeah, it happens. Yep. Okay. Well, that's why they do. That's why they split the roles between the new hires, because it makes the problem later less. Okay, so we're switching now to the Federal Reserve and monetary policy, but I have one more personal finance example that I worked out, and I thought, well, should we do it? And I thought, why not? And this has to do with the yield curve volatility, which I illustrated in a prior lecture, that, this thing is really flapping around quite a bit, and it's the difference between this red line and this black line. And so one of the questions is, how do you think about how volatile it is? Well, one of the ways to do it is you look at the differences between the change in the short-term rate and the change in the longer-term rate. And you can do it daily, monthly. There's so much data out there. You can do it for any particular period of time. And you say, well, if the yield curve were relatively constant in terms of the relationship between the long bond and the short bond, then what you would expect is when you plot the dots of the change in one rate versus the change in the other, you get some kind of spherical line here. They all they all move together. They're very correlated. And the daily rates indicated that it's not a lot of correlation. That looks more like a bullet shot. So maybe we should lengthen it rather than doing daily changes, do monthly changes. I have fewer dots because I'm using monthly data, month-end data rather than daily data. And nope, it's still a bullet. And I tried, what about a different maturity? This one was using the 10-year maturity. This one's using a 2-year maturity. This is daily rates. And sure enough, if you just look at the picture, you say, well, it's still moving around a lot, but it's not moving around as much as the 10-year, which in my analogy of the movie of the flapping yield curve, it shouldn't surprise you that those that are closer to the short end of the yield curve, but they're just not going to move. They're not going to move as much as the ones at the 10-year. And sure enough, when you pull the data, it shows it. And sure enough, you can do it for a longer period. This is month-end changes. And for 3 month and 2 years, well, it looks pretty correlated, but there's a lot of difference. There's a lot of difference between it moving in the same direction versus the number of dots where it's not moving in the same direction. It's moving the opposite way. Yes. It's not what the question is about an inverted yield curve. It's about 60 slides in. So hold the question. And what you will see is it's about what inverted yield curves tell you about the economy. It's not that they're bad for the economy. It's that yes. I'll show you some stuff. So here's a 4-graph summary in terms of this. And my whole point of thinking through in terms of the advice is with stocks, it's really easy to convince people you don't know anything about the short term. Just think about this in terms of the long term. Get a diversified portfolio. How much of your wealth you should put into it is based on your age, et cetera, and live with the volatility of a diversified portfolio. You put a proportion of it into fixed income instruments that's going to reduce the volatility. That's the standard advice that a good financial advisor will give you. With interest rates, because you hear about them, people think they know a lot more about interest rates than they in fact do. And that's what this lecture is really about. It's all about interest rates and how complicated they really are, because interest rates are the intersection of what is transacting in financial markets and the central bank, to which we now turn. Oh, I forgot I have 4 more tables. I summarized it. And basically what this says is your uncertainty, your months of change, okay, they get a little bit more correlated, but not a whole lot more correlated. And sure enough, 3-month treasuries and 1-year treasuries are more correlated than long-term treasuries. All of this it's just about to tell you that betting on interest rates is very, very difficult. They're right there. You walk by a branch, they got a CD rate sale. Oh, you haven't seen a 5% 5-year CD rate forever. Oh, now's the time to do it. Is that what you think? I don't know what, it seems like a good bet, but it's a bet. Okay. There's so many different times where people have made that bet or didn't make the bet thinking, oh, because interest rates are going to go much higher or much lower, that you don't know. So all of this conclusion is to talk about what it is that we know about financial markets and what the fact that we know so little about the short term. I have news for you. Those who spend their lives, their professional lives, looking at the short term, they don't know much more than we do. They just have a lot of electronics sitting in front of them to make guesses, and maybe they guess right proportionally more of the time, but you're not that person, so forget it. Okay, so what is this lecture? It's now lecture 5. What is it? Okay, first of all, why in a course in finance, everything you want to know about finance, why in God's name do you have to hear about the Federal Reserve? Well, because they're the ones printing the money, and money is finance. So we're going to talk about that. Just a few slides on just the structure of the system. It is a primer on the control of the money supply. This is where you get into monetary policy. This is the intersection. This is what's happening. This is the intersection between macroeconomic policy and interest rates. What are they trying to do? Why do they target the inflation rate? What is quantitative easing? This guy here, you're going to see a lot of data on this guy here. I don't think we'll get to it today. Quantitative easing is a big deal, okay? Anytime you start talking about $8 trillion of holdings on the Federal Reserve, $8 trillion, yeah, it matters. It matters a lot. The pandemic intervened. That's one of the reasons it's 8 trillion. And the what's called the stagnation hypothesis, and why I expect interest rates once we get over the cycle to go down, but I wouldn't bet the ranch that I'm right. And I don't. So why talk about the Federal Reserve? First, interest rates are ubiquitous. They're all over the place. We got all kinds of interest rates. We've talked about this before. You got the prime rate and the Fed fund. The definition of the prime rate is totally changed. Used to be the prime rate. The word prime meant, oh, this is the rate the prime corporations get because they're prime. They get a lower rate. It used to have a whole corporate influence. Well, with the evolution of the credit card industry, now the prime rate is largely relevant for credit card rates. You got the federal funds rate. Why it's so special? Oh, I should have taken this off. LIBOR. The LIBOR rate no longer exists. Why does the LIBOR rate no longer exist? Because there was a scandal several years ago by several large investment banks manipulating the LIBOR rate, and so the Fed decided to trash it, and it went out of business as of June 30th last summer. How do all these rates work? And the real point is they all matter. Every single one of them matters. They have buyers, they have lenders, they have borrowers. They're influencing the evolution of adjustable rate mortgages, including these guys called hybrids, in terms of how they work. What is that all about? It's why do they do it? Oh, well, because they can offer a lower rate for a fixed period of time, and it's called a hybrid because it's got a maturity date and then becomes a floater. So they use the term hybrid. And who's taking out hybrids? Young people for early mortgages, because they get a lower rate, and 5 years, life's going to be different. That maybe you're going to have kids and want to move into a bigger house. They know they're not going to be there forever. So you got to, it's slicing and dicing human behavior. It is the evolution of all of these different things. It is no different in a capitalist system than the cereal aisle at Safeway. Just walk down the cereal aisle and take a look at how many different cereals they have. And they're always coming out with more. And they're coming out with more shaving creams and razor blades. And, you turn on the radio, you hear Harry's advertising stuff. What is that all about? Product differentiation. Oh, if we just tweak this a little bit, instead of cornflakes, we have chocolate flavored cornflakes. Oh, we'll get a bunch of money out of that. Well, that was when my wife and I first took out our first mortgages, hybrids weren't even out there. arms, arms were out there, but now you got option arms, you got all kinds of stuff going on. And what is this about? Why am I in as a consultant to the banking industry? Because the banks are originating this product and they don't know how to measure and control its interest rate risk. And they're required to. And so therefore they need someone like me to come in and say, oh, do you understand this? Are you doing it right according to federal regulations? Which is all about the last lecture. Why do we have federal regulations in the banking industry? You'll see. So this is the yield curve. Everything is priced off this purple curve here. We talked about that earlier. It's really important to realize that that treasury curve, that's a special one. It's the benchmark curve. Everything is benchmarked off of that based on maturity and different risks. And it's important that this is the intersection of those. If you turn on Fox News at some point, they'll probably have another op-ed. We don't need to pay. We can default on treasury debt without consequence. Just, it's not true. So what is the Fed? First of all, the Fed was created in 1913. 1913. You can go into Wikipedia and you can look at the history. How did Congress come up with this? And it's all about the panic, the bank panic that preceded it, where it's a famous story where JP Morgan helped bail out the national economy, and the politicians kind of came to the consensus, it's probably not the best idea for running a government, having a private rich individual decide whether or not to bail out the government. And they had models for central banks, and that was the beginning of what the Fed did. So it is assigned by Congress and prior administrations for reducing unemployment and maintaining low inflation. It's in the law. You ever hear the term the dual mandate? Trust me, this is key. It says, this is why we're here. We are here to keep low unemployment and a low inflation rate. That is our job. And if we have to sacrifice unemployment to get the inflation rate lower, we will. And Jerome Powell refers to the dual mandate when he issues his various press releases. And think of it this way. It's really a pseudo independent agency. Okay, so how does that really work? Well, there's appointees by Congress, and there are several members of the what's called the Federal Open Market Committee that determines interest rates. And who are they? Well, they're presidents of the Federal Reserve banks. Okay, who appoints them? The banks. It's a whole world of organization, but in terms of full independence, the answer is no, they don't have full independence because Congress could change the rule. Congress could change the rule anytime they meet. To meet its assigned obligations, it sets short-term overnight rates, which are now called interest on reserves, which we'll talk about, controls the money supply, and it is the core part of macroeconomic policy. There's no question. The two big topics in macroeconomic policies are deficits and debt on one side and interest rate policy on the other. They can influence things in the short term much more quickly than Congress can pass a law and the president can sign it. And it also has this third responsibility. It is the regulator of banks, and one of its jobs is to prevent financial panics, a task assigned to it in 1913. Well, how did it do in 2008 in terms of financial panics? Yeah, a lot of people don't understand that, in fact, they blew it. There's no question about it, and put the economy through the ringer as a result. Okay, so the first thing to get through in terms of a course in finance and talking about the Fed is money. What is money? Everybody thinks they know what money is. Yes. Okay, so the question is, what can those in power, voted on by the people, what can they do to influence what the Federal Reserve does? Well, first of all, members of the board retire and move on, and they replace them with new members of the board. So over time, the president appoints and the Senate confirms appointee to the Federal Reserve Board. Okay, if they get too far out of hand, Congress can take away. Congress can do almost anything it chooses to do. It hasn't chosen to do it, but they have put who yes, Congress is very non-functional at the moment, and the Federal Reserve is actually acting in a way that it's supposed to act. And there's studies, for example, on the macroeconomic consequences of the quote unquote independence of the central banks. And there are different structures as you cross country boundaries. There are different structures regarding do economies perform better the more independent the banks are. And typically the answer seems to be yes. And most of them are not totally independent. Okay. And in Europe, they created a whole other problem with the single currency. Yes.
Dictate or control how much banks have to have on deposit in relation to the amount of loans banks make.
It's not reserves for deposit. It's not reserves for loans. It's reserves for deposits. For deposits, and those are called required reserves. And yes, and they are, trust me, it's not even close to $8 trillion. As so, the amount of reserves in the system are they're referred to as excess reserves because they're well beyond what is required. And the calculations associated with if you have deposits of a certain type, you must have certain reserves, and there's a lot of detail in terms of how you calculate it. Okay. You know, did you read my slides? No, the question is how does the Fed control the money supply and how does it actually work? And I'm going to get there, but not quite yet. You just have to wait. Ask me when you see the slides. We'll get there. So, what is money? First of all, it's a unit of account. Money is the value. All these things are measured, the pricing of goods and services. So it acts as the role of this unit is very important. We take it for granted. It is a store of value. Money means preserving purchasing power. Other assets may serve as a store of value, but not as a medium of exchange. Money is it's the most liquid of all assets because why? Everybody accepts it. Yeah. You get into a developed economy where they're having hyperinflation, watch what happens. Suddenly, the money is no longer a store of value, and one of the things they do is the developed economy can become dollarized. Dollar becomes the currency and the unit of value in these smaller developing economies. So you have to be careful. And it is the medium of exchange. It is the accepted method of payment for goods and service and repayments of debt. This is why cryptocurrency is a very interesting question. And when my son asked me about it, I told him, as long as it's not very big, the central banks will just study it and watch it and be concerned about it. But as soon as it becomes a real medium of exchange that they don't control, watch them pass a law that says you can't do it. They haven't, especially because of the dark web and the crime that goes on the dark web. It's a very interesting question. Yeah. Yeah, a retailer not accepting cash. Yeah. Yeah, well, the answer is that's an anecdote I'll share with my friends. They literally for a cup of coffee, you have to pay with a credit card. Uh, yeah, the dollars. Wow, that's a first. I'll, yes, I know about United Airlines, nice, but that's different. Yeah, that's a different. Did it happen because of COVID? Interesting. This is the other reason I teach the class, because I hear stories that go, well, none of my economist pals are telling me these stories. This is good stuff. Now I can tell. I'll get on an email tonight and tell 5 guys that said, "Look what I hear," and suddenly you'll hear this. Oh yeah, that's right. I was in Berkeley the other day and I couldn't. Yeah, how does that affect things? Okay, so money is not the same as wealth. It is not the same as income, and it's not the same as credit. These are all things that are different, that emanate in this financial world that we're used to. But as you'll see, they are all related. So the first thing to know about cash is one kind of money, but there's other kinds of money too. Checking accounts. Checking accounts are money you can write it. If you want to pay for something, if you're paying for someone who accepts checks. Yes, it is a form of payment for goods and services. Okay, so what we have here is, believe it or not, there's several other M's, but as you get into these M's, this is essentially cash and checking accounts. Then you start getting into savings accounts, short-term CDs and things like that. And the question is, okay, the reality is money too, and the definitions are complicated, because you can take money from a savings account and you put it in a checking account, and then suddenly you got a checking account. So how do we think about these things? And there's this other thing called the monetary base, and this is the part that the Fed actually has direct control over. The monetary base, by their purchases of bonds, okay, they control the amount of currency that's in the system and what are called the reserves in the system. And this is in terms of moving things back and forth, this is the essence of money. And as I said, the real world, it's complex. We get into the definitions. The most discussed in the monetary literature are M1 and M2. This was really big when Milton Friedman was alive. There was a lot of discussion saying, what do we need all these complicated macroeconomic models? All we have to do is control the money supply and everything will be hunky-dory. Well, it turns out, certainly now, we know that that's not true, because you'll see how the relationship has changed. But the reality is to just realize there's just tons of different definitions. You walk into a bank and you see all the different offerings of these different deposits, and some of them are classified as M1, some are classified as M2, some are classified as something different. And it doesn't really matter, other than to know, what do you know? Just the definition of money, what money is. It's a little complicated. And we can say how much is M1 and M2 is in circulation. Well, because they're the Federal Reserve, they can redefine things. So one of the things that happened is they redefined what was in M1, and so therefore the sum of M1 and M2, when you put them together, they trillions and trillions of dollars. Under the heyday of Milton Friedman, this view of the world should have converted immediately into much higher inflation, and it did not. Yes. The simple definition of M1, M1 is the very liquid measure of the money supply. It's primarily cash. So, it's cash, checking, and now accounts that can be converted to currency quickly. M2 is M1 plus savings accounts, small CDs, and retail money market accounts in terms of how they've defined them. Money market account, retail money market accounts. So this is both those that are not inside banks and those that are, banks also offer money market accounts inside banks. Yes. Yes. Yeah. That's right. I mean, look, they're responsible for managing the economy. They've got 300 PhDs working at the Board of Governors. Okay, they need something to do. And so what do? They're going to track details to find out, do these details provide us signals in terms of what we're supposed to do, which is manage the national economy. So if I start looking at, if somebody came up with a paper that said, you know, if you look at just focus on these guys, well, we get much better control over the economy. Well, they'd start focusing on those guys. But the reality is that most of the attention is really here and M2 and looking at the two of them. Yes.
In 2008, because I think this wasn't people could buy into money fund.
Oh, well, that was the one that broke the buck. The primary reserve fund that is outside of a bank. That is a money market fund, so the funds are not insured, and I don't believe that that's not the retail money. That's not the retail money market funds. But that
Professor,
was
can you
part of the
repeat the
melt. That
question for
was
us?
part of the meltdown, and it's Bernanke's written about it. What made him realize, going, sorry guys, show's over. We got to do something else.
Hey, Professor, can you repeat the question?
Yeah.
It's a money market fund,
Right.
which always paid a positive amount. But if they had to pay less than the positive amount, then they said it was break the money.
Because they didn't have it, because they put it this way, they didn't have the cash, and one of the reasons they didn't have the cash and from the interest earnings was because of the bankruptcy of Lehman Brothers, and that they had invested in a bunch of Lehman Brother bonds, which went bankrupt. Yeah. Yeah. All that they've gone through all that stuff. And so why do economists care? Well, you can build, imagine you're a monetarist economist and it's 1990, it's 1990, and you're looking at the relationship between GDP and the index and money funds. This is where Milton Friedman's having the heyday, going, why are we building all these models? It's not that complicated. All we have to do is really manage the money supply, and we're going to get a nice smooth curve here. And then you look at what happened as a result, and you go, oh, it was almost like just as they started doing that, things went awry, and it stopped working. And a lot of that is related to the financial supermarket. All of these things have complexities, and the number of different assets and liabilities and the behavior of individuals, households, and corporations regarding their managing stuff. All you have to do is say, look at the relationship before this and look at the relationship after, and it got a lot more complicated. No, he was not alive in 2008. But I think it was like 2003. I have to look up. Oh, and he lived in San Francisco. He and Rose lived in San Francisco in the last years of their life. So maybe 2006 and age 94. There you go. And we could have invited him in. He could have been a guest speaker. How cool would that have been? No, he's quite the entertainer. There's no question about it. Okay. So a little background on the Federal Reserve. It's the central bank created by an act of Congress, and it functions as the government's bank. It regulates and supervises bank. That's the area that I'm in. Acts of the lender of last resort, which means, what does that mean? That means when Silicon Valley Bank goes bankrupt, that means the Fed steps in and says, depositors up to the guarantee, you're not going to lose any money. That's what deposit insurance is all about. So it implements monetary policies, and for those with Netflix accounts, the best documentary, if it's up there, is called Money for Nothing. You might find it on Prime. It's a really good documentary on the history of the Fed and how its responsibilities evolved over time, how it blew it during the Depression in terms of, like if they knew then what we know now about the importance of monetary policy, it's quite possible that the Great Depression may have been averted. There's lots of debate there. You get into hypotheticals, you never really know. And for those with HBO accounts and you want to see it, the best movie in terms of the meltdown in September 2008 by far is called Too Big to Fail. It's the play-by-play. It's based on Ross Sorkin's book. Ross Sorkin was also one of the producers on the TV show The Billions. And he's still a journalist. He still shows up on MSNBC frequently, so I'm sure he's doing rather well. But Too Big to Fail is really quite an interesting tale about what was happening in those last few weeks in September and what happened. Okay, governance structure. How many people know about this kind of? You got board of governors, 7 members appointed by the president with overlapping 14-year terms confirmed by the Senate. This is where their power is. The president whispers in your ear, "We want you out of here." Are you going to say no to the president? Probably not. And then he gets another appointee. There's all kinds of stuff going on like that. Chair and vice chair have 4-year terms. 12 regional Federal Reserve banks, with the presidents appointed by the board of directors of the Federal Reserve banks, subject to board of governor approval. And this is why Neil Kashkari is the president of the Minneapolis Federal Reserve Bank. And you may have forgotten who he was, but he ran for governor against Jerry Brown. And he was in the room with Paulson and Bernanke during the meltdown of 2008. It's very interesting story. The key committee that everybody that's following markets follows, it's the Federal Open Market Committee. It's made up of the members of the Board of Governors and FRB presidents on a rotating basis. The Federal Reserve Bank, the president of the Federal Reserve Bank of New York is a permanent member, but the regional presidents, they rotate through. And this is the key. Not a single elected official sits on these boards or governance committees. In the nature of democracy, with enormous power. I mean, if they wanted to take out the president, all they have to do is raise interest rates, around June, to just keep raising them. They could push the economy into a recession, all that stuff, enormous amounts of power. It's an incredible story. And it's an incredible story about democracies. Are we glad that these people are relatively independent, even though there's a whole bunch of people who are being appointed by bankers to vote on this? Yes. Federal Reserve Bank, not Federal Reserve Board presidents, Federal Reserve banks. Those are the 12 regional Federal Reserve banks. San Francisco Federal Reserve Bank. Mary Daly is the president of that bank, and she gets to sit on the FOMC. Powell is appointed by the president. He's on the board of governors. He's one of let's see, with president. He's the chair and the vice chair have 4-year terms. He's appointed by the president. It is. Yeah. Oh, he absolutely is. Oh, sure. All the board of governors are on the Federal Open Market Committee. And here's the way one friend once said, it works. There's something like, like 12, 13 members on the Federal Open Market Committee, and the chairman of the Federal Reserve gets 13 votes and everybody else gets 1. in terms of how it works, because he's the front person for the entire institution in monetary policy. And they read the newspaper. They know what's going on. Okay, they know this is a prized institution in terms of its role, in terms of the economy. And, you know, they're sitting in there with a group of economists telling them for over a year to get inflation out of this system, you're going to have to create a recession. That's what they said. That's what they told them. Well, they've gotten inflation out of the system and we haven't experienced a recession. These better lucky than smart. And one of the ways this works is in terms of structuring is it's by geographic region. They have a whole bunch of responsibilities in the payment system. You know, the Fed wire, the transactions between one bank and another to transfer funds and all that stuff. The payment system is huge. Why the terrorists haven't gone out after one of the electronic chains where this is being transferred? I have wondered about this. You know, trust me, after 9/11, one of my pals worked at the San Francisco Federal Reserve Bank. The security, I mean, they would not let them bring in a laptop. He was not allowed to bring a laptop into the Federal Reserve nor take one out. And when he went on travel, they had special laptops for like meetings and conferences that he could use on travel. Just very concerned about security. Yes.
So the open market forces the presidents of the banks on a rotating basis.
Yes.
Except New York.
Except New York. I think I have that slide in there in terms of the actual count. This is the thing on independence. Just a minute. A federal open market consists of 12 voting. See, I looked ahead. 12 voting members, 7 members of and then the president. That's 8. So the other 11 rotate through. They all get to participate, but they don't get to vote. Okay, so they get to attend the meeting and all that stuff, but they don't have a vote. So the 7 non-voting members are rotating through. Eventually 5 years and the transcripts of the FOMC are released to the public. 5 years. In fact, I had one of my students who got sick and he couldn't take the final. What can I do? You know, you get him an eye. I said, read 3 months worth of FOMC minutes and tell me how it fits with what I taught in the course. He said afterwards, he said, hell, this is interesting. Yeah, it's interesting. It's interesting because there's power. You had a question. Well, you remember they defined these regions years and years ago before there was almost 40 million people in the state. So, you know, there's a lot of that. They're not necessarily balanced by population now. No way. So they're defined. There's a lot of, you know, if you want to start changing the boundaries, what's the real, what benefit is there? It's because there's so much integration in the banking system in those states with what's happening in the payment system, and that the responsibilities of the Federal Reserve in that system are so important. You start changing those things around, you're just going to have nothing but cost. You know, what's the additional benefit? Okay. So we did this. Independence we talked about. Okay. This is the part that's really interesting. How do they budget these guys? Well, it turns out, you know, they bought a bunch of treasury bonds, and you'll see they also bought a bunch of MBS. They're making zillions of dollars on the holdings of these bonds. They don't need it. And they remit what they don't need. You'll see a slide on this later. They don't remit what they don't need back to the US Treasury. Billions and billions of dollars every year is remitted. So this is reported. It's public information, and it comes with some consequences. I've never understood why it hasn't been brought up by Elizabeth Warren. We talked about this. The FOMC was not created in 1913. That was in 1936. It is the power. This is where it is. It's an incredible story of these 12 voting members having that much influence over the rest of us. And can you name anybody other than Jerome Powell? I can name Mary Daly because I've because she's at the San Francisco Federal Reserve, but I can't name that many. Yes, Lael Brand. She's I think she's the vice chairman. Lael Brainerd's vice chair. She came out of the Obama administration. Okay. And this is the question on releases. Meeting transcripts are after 5 years. There's a monetary policy report semi-annually, minutes released 3 weeks after the meeting. And I should tell you, in the summer of 2008, when the economy was melting down, did any of the minutes reflect on, this economy is going to melt down and we shouldn't let Lehman Brothers go bankrupt? You'll hear about this. You'll hear about this more later. This is what they're paid to do. And it shows you how they were surprised. So here's the primer on the money supply process. How do they do it? Well, the right way to think about it is this triangle. There's 3 different groups out there. First, there's the Fed deciding what to do in terms of its buying and selling of bonds. Okay. There's the public, firms, people, they hold money as currency and deposits. We're making decisions all the time. And there's depository institutions that accept deposit and makes loans. So all of these 3 things come together in terms of what the Fed is doing, because it doesn't manipulate M1, it manipulates the monetary base by what? Buying treasury bonds, putting cash into the system, and then it floats through the system and then starts showing up in banks. Do the bankers lend it out? This is where, when the huge reserves during 2008 and 2009, gee whiz, and the economy was weak. The reason we have this recession is because the banks aren't lending it out. If they only lent out their money, everything would be hunky-dory. Well, it doesn't work like that either. So, and you got public in terms of how it's amazing it works as well as it does. So the bank, it's from a standpoint of high level in terms of what you really need to know. Well, when it puts cash into the system, it's buying assets from the public, and the primary assets it's buying from the public are of 2 forms: mortgage-backed securities and treasuries. Pre-2008, it was just treasuries, but since 2008, they've been doing both. And if it wants to reduce the money supply, okay, it sells them. Why? Because when it sells a treasury bond, it takes it out of its vault and sells it to the public through there's specialized brokers that deal with this in terms of how the markets actually interact in terms of what they know and what they're allowed to tell the public, all the rest of that stuff. But they decide to sell bonds, and money comes in, and they bring the money in, they put the money in the vault. And this is what is referred to as monetary base. And of course, in economics and finance, you can't just have one name for the same thing. You got to have 2 names at least to confuse the public, because the monetary base is also referred to as high-powered money. I was long out of graduate school before I knew that. There's all kinds of stuff that comes up like this. You mean they're the same thing? Why don't they come up with one name? So they're controlling this guy, okay, which has an influence over this guy and less of an influence over M2. And everything changed, and I'm going to tell you about both ways, because most of the macroeconomic textbooks, it's amazing, they have not been updated. The Fed has changed. Dodd-Frank changed everything. Okay, the way it used to be was the way that the Fed controlled stuff was through what's called the Fed funds rate, the overnight trading rate among banks inside the Federal Reserve System. They could buy and sell cash to one another, and there was an overnight rate. And by monitoring that rate, they would adjust how many bonds they bought or sold in order to control the rate in the target range they wanted. In December 2008, because they didn't want negative interest rates, they said, we got so much money out there. The only way to do this is to convert the system to what's called a floor system. And now it's administrative. It's called the interest on reserves. They set it. That is the rate. It's what they call it. It is nothing else. That is the rate changing, and it's changed the whole nature of how that market works. But this was the basis for macroeconomic courses, Samuelson's book, all of them, in terms of how was money supply controlled through the buying and selling of bonds. You had a lower target rate. It would put cash into the system if it wanted the rate to come down. It would pull cash out of the system if it wanted the rate to go up. And it worked extraordinarily well. It worked extraordinarily well to December 2008. And that's when everything changed. And it changed like this. The whole idea is the macro. What are they doing here? Okay. The whole idea is through the money supply and interest rates, they're influencing what's happening in the economy. So under the old way, the Fed sells treasury securities to the market, the monetary base decreases, banks reduce lending, the money supply decreases, and they get the effect. There's less economic activity. It helps deal with reducing the inflation rate. It also generates more unemployment because there's less economic activity. But this kind of diagram is standard plain vanilla. Well, this doesn't do it anymore. Pardon? Well, that's one of the, I mean, given the size of the debt that's out there in terms of who's holding it, there doesn't seem to be any hesitation for markets to buy treasury bonds, as you'll see in a diagram I show you next week. You'll see so far, as we like to say, up to now. Yes, there can be dysfunction, and there was dysfunction in the treasury market a couple of years ago. And the opposite was true. The Fed buys treasury securities from the market. The monetary base increases, banks lend or not. The money supply increases, banks hold excess reserves. This was the question about the reserves. And the money supply stays relatively unchanged. So there's some looseness in the process of controlling the money supply, because this is what they directly control. And notice this, the banks lend or not, and this how it affects. This slide is out of date. I'm showing it to you so you understand this is not how it works anymore. And there was just a column in the New York Times complaining that the economic textbooks that the undergraduates across the United States are getting in their macro course have not been updated, because they can do whatever they want with the monetary base because it's divorced from the interest rate. The interest rate is the rate that they set. It says, oh, you have excess reserves. This is the interest rate we pay you on those excess reserves. And that is, in essence, an overnight rate. And that is the relationship between that and the entire yield curve. The three-month rate's very closely related to the little volatility there. But for the most part, that's how they're setting it. And how many people understand that this was huge, and it was required because of what happened in September 2008. September in 2008, in terms of the meltdown and the financial panic that followed it, has had huge consequences. Huge consequences on the economy, huge consequences on our politics, and our misunderstanding. And I'll just plant the seed, and this is where we'll start up next week. So you look at the monetary base up to August 2008. This is, we're talking about billions. So this is 1 trillion, 2 trillion, 3 trillions. Okay. Look at what they were doing. You know, yeah, there are wiggles and waggles, but for the most part, you don't see excess reserves because they weren't excess reserves. The banks they were lending everything out. And then we had the meltdown. And I set these up at the same size. This is the assets holdings of the Federal Reserve. This is what they were thinking they were going to accomplish at the end of 2019. And then the pandemic hit. And as of this goes out to about a week ago, their holdings were now $5.5 trillion. And they're holding $2.5 trillion of that's currency. And the rest of this is excess reserves. And this is how they've invested it. Wait a minute. I want to get to this one. Yeah. This guy. Got the I'll get to it. We'll get the real point is all about this term called quantitative easing. What was that all about? And the answer is we'll start off next week, is because the Federal Reserve Board on its own decided, unlike Europe and Japan, they don't want negative interest rates in the United States. And how are they going to keep it from being negative? They're going to wipe out the federal funds market from a standpoint of how it operates and replace it with, this is the rate you get if you give us your reserves. That's an administered rate. So it's no longer functioning of a signal as to what's happening in a marketplace. And they had to do it because the economy was weak. Their job is to stimulate economic growth, but they didn't want negative interest rates. So they did the best they could by buying huge amounts of treasury bonds and mortgage-backed securities. And that's where we'll kick off next week. Perfect. Okay. You want me to go another hour?
Thanks, everybody. We'll see you all next time. Bye, everyone.